indices, we look at the Nifty heat map, just a quick sort of state of play, and then we look at individual stocks. So 24,570 on the Nifty. We're up, barely up, but up. The Nifty Bank is up about 0.25%, 55,740. Sensex is up about 0.25%. Small cap index is up 0.4. The mid cap index, I think, is also starting about 1/3% higher at this point in time. So, I mean, it's an unremarkable open, but it's a positive open. It's a higher start. The heat map should give you a quick sense of how the Nifty 50 stocks are opening, and then we will take it from there. It's all positive. I mean, I think you've got about 30-odd names, not all, but 30 stocks are higher. And you got about 16, 17 names which are starting in the red. Nigel.
Well, the stocks actually, there are a few of them that are reacting to individual news flows. So you had Pharma, they have announced the top-line results for a phase 2 trial of SCD-044. I think the drug did not meet the primary endpoints in either study. And because of that, you have Spark actually that's pulling back a goodish bit. Spark is actually down close to around 8.5%. So you should pull that one up for you on the screen. ABFRL, the large trade due, that explains why the stock is down close to 7%. 6.23% equity changes hands in all probability. Flipkart is likely to be in the seller out there. So that's why, in fact, that stock is lower in trade. What else is moving around? Indegene, well, that stock as well is down close to around 4%, I think. Out there as well, we had a large trade that was due. I think that as well has got cleared out. So keep an eye out on that particular name. On the upside, searching for a few winners since the markets are green, actually. Let's get a few of them up for you on the screen. Not finding any notable one. I think you had Everest Cantor. That one is up close to 3.5%. Lloyd Metal. Yesterday, I think we had Jay Bala who was saying on the charts that stock is looking quite good. After testing around 1,100, well, that's pulling back in style. Up 3.5% as we speak. So big up move is what we're seeing out there. Motilal Oswal actually is doing quite well this morning. Stock is up 3.5%. Volumes as well very, very high for the initial few minutes. And Swiggy is the other name that's sitting with a gain of close to around 3%. Add to the list a Kochi shipyard as well. Good gains on that one. And volumes as well fairly good in today's trading session. Spark is now down 10%. So I think that's calling for attention. And NMDC, the price cut that was actually awaited and the street had a sniff of it, though the management yesterday was non-committal. But that 100-150 rupee price cut is something that the street was working with. That one as well comes up for you the screen with a mild cut of around 1.5%. Tata Tech close to around 750 rupees because of the large trade that was due out there as well.
No, absolutely. And I think we'll have to look at some of this stuff more closely. But, I mean, blocks and blocks and blocks. It's just been incredible, the pace at which it's all sort of coming, but also the pace at which it is all being absorbed as well. What do we have? I mean, right now with regards to market, it's still early. I mean, stuff is still opening, but it's positive. I mean, 2:1 in favor of advances is what we have. The number one volume-led gainer on the Nifty is Motilal Oswal. It's up 4%, and it's got twice the volumes on the NSE compared to the second largest volume-led gainer. Shipbuilders, once again a theme, and they always move in a pair or, like triplets. But Garden Reach and Cochin are the two names which are moving higher at this point in time. Garden Reach is up 5.5%. Cochin is up about 2.5%. Radico, I'm not sure we highlighted. Radico is up 4%. That's a pop, straight up. 2,800 on Radico, and it's got very large volumes, 140,000 shares right now, right at the word go. There is Premier Explosives, which is up about 5% as well. I can spot Hitachi, which is up about 2%, and there is Jubilant Food, which is up about 3% or so. And there's Techno Electric, which of course has done very well from the recent lows of about $1,000. Stocks at about 1,500. Policy Bazaar and Genus Power and Torrent Power. But then volumes start to fade off very, very fast as you kind of go down the list. The two biggest volume-led losers, as Nigel mentioned, of course, are stock stuff where there are blocks.
Yeah, just one point on Motilal Oswal. The reason of that volume spike is 0.5% equity has changed hands. We'll have to check out who exactly with the parties. But for the time being, that explains the big volume surge that we're seeing. And a couple of other names, the Anil Ambani Group stocks, Reliance Power as well as Reliance Infra. Last 10 days or so, we have had massive volume action. Yesterday, it ended lower, both those two stocks. Today as well, very, very large volumes for the first few minutes. Both the stocks mildly higher.
I mean, they're back in that sense, right? I mean, the stocks have done phenomenally well. Both these names, Reliance Power and Reliance Infra as well. Well, let's welcome in Amish Shah. He's head of India research at BofA Securities. Amish joins us from the sidelines of the BofA Securities 2025 India Conference. Amish, good morning. Great to have you here. Prashant this side. We spoke to you when the conference was starting, so let's do a little bit of then and now. Although the then and now are only separated by 3 days. So what are the one or two things which really stood out to you from the conference in terms of takeaways from all the conversations you've had and sort of made you sit up and take note of in terms of what was happening?
Sure. Good morning. Thank you, Prashant. So look, I guess there is definitely optimism within, across all sectors, amongst all companies. But at the same time, they are quite measured. So I think the message that we've got is that everybody is cautiously optimistic. The other trend that we've picked up is a majority of the companies are talking about how there might be a slow start to the first half of this fiscal, but most of them are expecting it to accelerate in the second half as we go along. So sector after sector, we heard it from IT, we heard that from consumer, from autos, from banks. So I guess the mood is that once the geopolitical and global macro issues get more clarity, there will be more growth visibility as we go along in the second half.
All right. Hi, Amish. Good morning and good to see you, Ben. What about, the biggest concerns with regard to the Indian markets? Flows seem to be good. Earnings are yet to catch up. But if you could highlight, a couple of concerns that your interactions with a lot of the investment community did throw up.
So, Nigel, I think the concern is that versus what the companies have already guided, at the margin, the tone is getting a bit more cautious or companies are highlighting more risk factors or factors that they are watching out before the companies themselves get clarity. I'll give you some examples. So auto companies, for instance, are talking about rural markets recovering, but at the same time, growth in the urban markets peaking off. If you talk to IT companies, they are talking about, slightly better than what they expected in terms of spends on cost takeout programs. So they are getting more deals, but yet they believe that till the time US-China trade issues are not sorted, their customers in the US are not able to make the full tech budget decisions because US-China trade deal is absolutely an indicator that the trade wars are behind us. So IT is waiting out for that. Banks, they know that the NIMs will compress on the back of rate cuts that are going through. And loan growth generally is not that, June quarter is not the best quarter for loan growth. So they're expecting an acceleration. But do you grow in unsecured, where there could be pain points in terms of NPAs later? If you try to grow in secured category, the NIMs are quite low in terms of mortgages, etc. So I guess, even the corporates are right now trying to figure out, on absolute all factors. They don't have clarity on all factors right now. So there is a bound of this cautiousness that they are highlighting. Which is also keeping the investors a bit confused on whether should you go whole hog or do you wait out for the clarity to emerge. So I guess those are at the margin some concerns right now.
On the banking space, that's going to be interesting because everyone's waiting by for a rate cut. But in the near term, actually, rate cuts will put pressure on the margins. And as you said, the loan growth is still being quite anemic. Are investors prepared to look ahead? Because as things progress, the first hit comes on the loan rates. And later on, in fact, the deposit rates as well will cool off. So ultimately, the NIMs will look good in the longer duration. In the near term, in fact, there'll be that headwind. Are investors willing to look ahead? And suddenly, in the last month or so, these PSU banks, they have come back into play. Is there a lot of interest for PSU banking names?
So Nigel, first of all, financials is at least a sector that unanimously everybody likes, including us. But then the answer to your question really depends on my investment horizon. So if I'm an investor who's mostly a hedge fund and cares for near-term triggers, they are not that excited about financials as of now because they do think that loan growth revival will take some time, but the NIM compression will be in the here and now. So you're first looking at a downprint and then you're going to look at an acceleration. But the long only investors are basically waiting if there were a correction on the back of that, because they want to, as you said, they want to look ahead and they want to use this dip as a buying opportunity. In context of the banks within private and SOEs, etc., I would say that again, that depends on how much risk you want to add to your portfolio. So if I'm an investor who's happy with steady returns, but a safe stock, then I still want to be invested in the top 2 or 3 private sector banks. But obviously, if I want to add beta to my portfolio, and I don't mind taking a little bit of more risk, but I want higher returns, then SOE banks are definitely finding favor because, there at least valuations for SOE banks, as we know, is quite cheap. A lot of them are still trading below 1-time book. So the expectation is that when the cycle turns, it will be favorable for all banks, and cheaper banks should therefore give you higher returns.
No, absolutely. Amish, there are so many, in a way, and India, the beautiful thing about, of course, the market here is it's not concentrated in one segment, right? And I think that's a point that you've made before as well. And global investors appreciate it's not metals heavy or tech heavy like many of the regional markets are. So you really have a buffet of stuff and a big one. But incrementally, I'm keeping aside some of the older legacy sectors, which are the sort of newer areas where investors are really looking for ideas in. And in these new areas, there are lots of sort of companies making it to the market with IPOs, etc. as well. So just give us a tease about that, 2, 3 sort of newer segments in that sense.
So Prashant, actually there are plenty. You're very right. India clearly has a lot of opportunities, and a lot of interesting companies are now getting listed in a variety of sectors that we were earlier not looking for. So I think valuations aside, but sectors that really excite investors right now is EMS, semiconductors, biofuels, green hydrogen, data centers, travel and tourism. So clearly there is a variety of things to choose from. In fact, even in the consumer durable space, there are some interesting listings that are expected. So that space is expected to go wider. Every time that you hear about an industry body talk about manufacturing, electronics is only expanding as an ecosystem. It started with mobiles. Now it's being expected that it will roll over to consumer durables, and it is expected to go to tech hardware, and then semiconductors comes in by that time, gives you visibility. So there is definitely traction to all of these themes. In some cases, valuations though may not be to your comfort.
Okay, all right, Amish, post this run that we have seen, and when we went to around the 22,000 mark, you all were quite positive. Now, do you think for the remainder of this year, fixed investment bonds, they will offer better returns in comparison to the Indian headline equity market?
I would say so, Nigel. On a fixed income product, you can make about 7% pre-tax, but that is definitely in the bag. Whereas for the Nifty, as you know, our target for this year is 25,000. We are only about a percentage away from there. So clearly the conviction that markets could give me even a high single-digit return is not very high. So if I can get a safer return in a fixed income product, then I would probably look to avoid the risk of equities right now. And when I go to the broader markets, there, as you know, our views have been negative. Because we think that large caps are still sensibly priced or fairly priced, but the mid caps are actually quite excessively priced. So I would say that if you're a patient investor, you may want to step aside, get into fixed income for some time, look for markets to get cheaper, and then equities, obviously, in India from a long-term perspective, is definitely going to outperform debt over long term.
Okay. All right.
No, absolutely. And I think those are important points there that you make. Amish, thank you very much for joining us. It's a pleasure having you here on CNBC-TV18, and look forward to our next conversation. Thanks indeed. So that is Amish from the sidelines of the BofA Securities 2025 India Conference. Let's just take a quick look at the market. We're up 40 points, 24,580 is where we're at. And it's still holding on very, very well. Lots of new stuff in the mix. By the way, and we should put these stocks up at the bottom of the screen, the 3 biggest volume-led gainers actually are shipbuilders. The top 5 volume-led gainers across the NSE are defense companies. So if you can have Garden Reach up, I'll just quickly run through these. 8% higher on Garden Reach. It's a new all-time high. So there you go. Let's look at Cochin Shipyard, 4.5% on Cochin, 2125. Almost a new all-time high. The all-time high on this one is about 21.95. It's at about 21.24. Mazgaon Dock is up to about 2.5%, 35.31 on this one. BDL, that is Bharat Dynamics, is up 3%. BEML is up about 3% as well. And which basically means that it'll all show up on the Nifty Defense Index. I think should be up at least 2%, if not more. And we look at that as well. But there is so much more stuff which is starting to come up and show up. Almost 2% there, 89.45. So really the sector of the day so far. Nifty is cooled off a little bit. We're still up about 25 points or so. Cement, Nigel, is in focus with the Jefferies view, isn't it?
Well, that's right. You know, Jefferies is pointing out that actually in the past quarter, that's quarter four, there was an improvement that they saw in profitability. So they say that, in fact, there's a strong rebound that you're seeing in quarter four. Remember, the previous few quarters was a little bit subdued. So they point out that quarter four EBITDA growth was in the vicinity of close to around 11%. That's on a year-on-year basis. Keep in mind, pricing was still weak, but yet they delivered a EBITDA growth of 11%. And on a sequential basis, it was beautiful. It was a 60% recovery because quarter three was an absolute washout. How did they manage that? There was a recovery in pricing, and there was more or less steady volume growth because you're not off to the races with high single-digit, but mid-single-digit growth is what most companies deliver. They go on to point that quarter one could be better, particularly for the segment of the market that delivered awful numbers. That was a South industry. Because of their price increases didn't really fructify. But now price increases are coming about. So quarter one could be far better. They say that they're expecting the sector, cement sector on the whole, to turn around in FY26. And in terms of their top picks, they're pointing out that Ultratech, Shree Cement, as well as JK Cement, all of them are the top picks in that space. But I think, Prashant, you were talking about shipbuilders. Let's stick to that theme. Let's talk about shipping, another ancillary out there.
No, absolutely. And, it's an industry which is, of course, it's got its own ebb and flow, but I think there is also a lot happening on the global side with regards to sort of conflicts. Always comes up as a sector to look at from a broader perspective as well. Let's focus on the space now. And Trump's tariff war, trade war, is, of course, getting more entrenched, if anything. The good news seems to be behind, and now we are, I guess, entering a bit of a more tougher sort of a space. Remember, those 50% tariffs on steel and aluminum go into effect. That order has been signed. And there was that Wall Street Journal report which said that China wants to play hardball. They're not going to sort of lay down and let the Trump administration do what it wants. So a more tougher, contentious kind of phase with regards to what's going on here. We have Mr. Shiv Kumar. He's Executive Director and CFO at GE Shipping. He's with us now to take some questions. Mr. Shiv Kumar, good to have you with us here. Thank you very much for your time. I just wanted to, before I get down to GE Shipping, I just wanted to get a quick sense on, some of the bigger stuff. From the last time we spoke, have things changed in any which way? Also weigh in on these steel and aluminum tariffs. Will that make a big difference to the shipping business, the bulk business?
Yeah, morning, Prashant. Thanks for having me. Not much significant change on the commodity trade from the tariffs from the last time we spoke. Steel could be affected. Yes, again, it's a small part of commodity transportation, especially steel into the US. It's not a huge amount. Remember that the overall dry bulk trade is 5.5 billion tons. So it's not a large part of the trade. Aluminium also not a huge part of the trade. We have bauxite, which moves a lot, alumina in a smaller way. But again, unlikely to be affected in a big way here. So not much on the commodities front from this latest round of tariffs. Really.
Not of course, we're not from an India perspective, but I mean, your business is global, Mr. Shivkumar. Even there, not very much in that sense?
Not really. The steel trade is not a very large part, especially the US imports, not much at all. In fact, the Chinese exports of steel are pretty low, less than 1% of overall steel, overall dry bulk trade.
All right. Hi, Mr. Subkumar. Good morning and good to see you, Ben. So you're basically, if I got that correct, you're saying demand hasn't got hurt by this additional round of tariffs. Is that correct?
Yeah. So it's unlikely to have a big impact. Demand probably gets hurt. I'm just saying it's not going to be significant because it's a very small part of the commodity trade overall.
No, this aside, I'm saying for you, demand on the whole, are you seeing some kind of a slowdown in terms of movement, in terms of conversations that you're having? Leave this aside with regard to the smaller part, steel as well as aluminium. But on the whole, dry bulk, is there a slowdown?
Yes, there is. There is one specific trade which is affected by the tariffs, which is the US-China grain trade, because China has put tariffs on US grain as well. So that has slowed down significantly while the importers wait for the outcome of whatever talks are happening between the US and China. So that trade has slowed down significantly. But otherwise, there is not really anything much. I think I'd mentioned the last time I was here that the LPG trade also is affected by this because there's a lot of LPG, specifically propane, going from the US to China. That again has it slowed down a bit, but I think the trade has rerouted and it's sort of adjusted now.
You know, Mr. Shivkumar, we've been having these conversations with global trade economists, etc. You must have seen the OECD forecast as well, growth for sharp cuts. I spoke with the Morgan Stanley global chief economist, right? I mean, they're all expecting, the markets, of course, when I say markets, I mean stock markets. They're not reflecting it, but they're all expecting a pretty sharp slowdown in the US and as a consequence of it for global growth as well later this year.
Yeah, while we're not seeing specifically tariff-related issues, we are seeing maybe some impacts on overall growth. The oil trade has been pretty weak. We're already seeing revisions in oil demand growth numbers for forecast for 25 over 24. We are seeing iron ore, coal trade also being weak. Again, those are driven. Iron ore is driven in a big way by Chinese steel production. Coal is driven in a big way by Chinese imports and by Indian imports. And again, domestic production in both of these countries also affects it. But in general, I would tend to agree. The oil demand has been lackluster. The demand growth has been lackluster. So there does seem to be some underlying pressure on the macro.
Got it. Okay. All right. Let's talk about pricing then, sir. Could you tell us, for the various segments that you operate in, what has been the pricing change? Say if you compare the Q1 average with what we saw in Q4 or with Q3, how has the trend moved?
As it stands, it's not very different. Again, I'd like to add here that this is traditionally a weaker period for tankers because tankers typically have a strong winter and a weaker summer period. Again, we did not have a strong winter. So markets are marginally weaker in some sectors for tankers. But in general, I would say we're about the same as we were in Q4 FY25 because Q4 itself was not a very strong quarter. Dry bulk, again, is the opposite of tankers in seasonality. Typically for them, March is the weakest quarter and it starts recovering. So we are seeing a little bit of a recovery in dry bulk rates, but not a huge amount. So it's much of a muchness, really, if you take the entire fleet. Not very different from Q4 FY25 as it stands today.
Okay, got it. All right. Let's talk about the smaller part of your business, the offshore business. How has the pricing trends been out there with regard to rigs? How many of them have already been repriced? How many of them are due for repricing? And what is the rough change out there? I recall a few years ago, Mr. Shivkumar, when you used to come, we used to talk about how that business is turning around. It turned around a little bit in the middle, but I want to know what's the recent trends in terms of pricing?
Yeah, so the story for the last 15 months is that there's been a significant setback. Saudi Aramco off-hired, I think, 24 rigs in the last year or 15 months, which has had a big change a big impact on the sentiment overall for the jackup rig business. So we had one pricing for a 3-year contract in India for a rig which is coming off her previous contract, the end of calendar 25. That pricing from the last pricing we had for a similar contract in India was in end of 2023, before the Saudi Aramco actions. So that pricing is probably down more than 50% on a day rate basis. And again, this is what happens in tender pressures, where the number of bidders is more than the number of rigs which have been asked for. And where you have to be L1 in order to get the contract, and you have to match L1. So pricing has come down a lot. It's still positive on EBITDA and significantly positive on EBITDA, but it's a huge drop in pricing. So to that extent, the rates are down. We also have two rigs which have got short-term contracts. So one is a 4-month contract, one is a 6 to 7 month contract. These are the minimum periods, both of which will go onto contracts by the end of calendar 25. So we chose to keep two of them on short-term contracts because we were not very happy with the long-term rates. The short-term rates, of course, are significantly higher than the 3-year contract that we've got.
So how much higher are they, sir?
They're probably 50 to 60% higher than the long-term rates.
Okay, the short-term one. And the long-term rates you said are how much lower?
About 50%, more than 50% lower from the pricing of calendar 23, end of 23.
Got it. All right, Mr. Shivkumar, we appreciate you joining in. Looking forward to chatting up with you, maybe post the conclusion of the Q1 results. But thanks a lot for giving us some color on how you see the industry panning out from here on. Well, for the markets on the whole, while we're having that chat with Mr. Shivkumar, well, we had the Nifty Bank. That one has dipped a little bit. I think now it's closer to around, moving a little closer to the 20 DMA, which is the important mark. The last few sessions, actually, what's happened is some of these private banks, they have been doing a relative underperformance. But as Prashant said, the likes of Garden Reach, Kochi Shipyard, well, they are on fire. Those stocks are doing a thing of their own. We slip into a short break, come back. We'll be joined by the management of Mastek to talk about the quarter gone by and the outlook going forward. Stay with us. Welcome back. Markets more or less flattish as we speak. The Nifty at least has flattened out, and the advanced decline ratio, which started firmly in favor of the number of stocks that are advancing, those lines are getting closer. They're going to be kissing each other soon, I think so. It's almost pretty much even Stevens. The crisscross lines should come up for you on the screen. But this is Corporate Radar, so let's invite our next corporate on the show. We have Mastek. They announced their fourth quarter's numbers, which beat estimates, although margins were a little bit under pressure. But what's the way ahead? Mr. Desai, the Vice Chairman and the Managing Director at Mastek, joins us on the show. Hi, Mr. Desai. Good morning. Good to see you in, as always. Thanks a lot for joining in. Well, let's talk about business, how things are shaping up. NHS revenue first. What was the contribution in FY25? And what's it going to look like in FY26?
See, revenue growth, as you know, for FY25 has been around 14% year on year. That means annual revenue growth, Nigeria. So the whole thing was, this is much better than industry, as you know. Industry did grow much lesser than that.
Mr. Desai, I was asking, what is the NHS contribution in the past year?
We don't have a contribution like that, each customer-wise. But healthcare together account for a fairly large percentage, close to 20%. And that includes, of course, NHS and other US healthcare providers that we work with. And that's a focus area that we have. It is next to our government and education sector.
Got it. All right. Just to get some more color on NHS, it's been around 3 months since NHS was abolished. Any spending cuts that you have observed?
No. In fact, in NHS, we have been very happy that some of our old projects, Nigel, which were actually under some kind of suspense due to a lot of changes that were happening over the last 2 years, which did affect us, as you know, have now started moving ahead. And we are booking orders as we speak. So we have not seen much impact, if you look at it that way, from these changes in NHS, because there's an existing commitment that NHS has made in terms of our backlog, in terms of the work that we do, and more work that they want to do.
Okay. All right. Got that. Give us a broad idea, sir, qualitatively at least, how Q1 has been so far. Now, in Q4, there was plenty of uncertainty, right? Yet you grew by 2.9% quarter on quarter, which the street liked quite a bit. Many other of your peers, they reported a decline. So as things stand in Q1, how are things panning out?
I would not like to speak specifically on quarter now that we are almost very close to the quarter. So I would focus generally saying what has been our focus area, Nigel. We are focusing on, of course, in our UK market, government, SGS as we call it, which is growing very fast. We have booked a lot of new orders. In fact, some of the orders were just booked post our results announcement, which we announced very early, as you know. And as you asked me about NHS and healthcare, these two sectors are doing well for us across the countries that we are speaking about. We always like to target, and we have done that over the last 4 or 5 years, as you know. I have grown faster than the industry in terms of our revenue growth. And we would like to move in that direction during this year too. And I think we are well focused to reach that given our strategy.
Okay, let's focus. Mr. Desai, we won't push you. We don't want a quarterly number. Let's talk about the year. Last year you grew in double digits. This year, is it possible?
As I said, we would like to do faster than the industry. So I would like to definitely say that we would do better. You see, there is an uncertainty, you must realize, in terms of US-related issues. We all know that well. And how it pans out in second quarter, we have to see in terms of its impact on the market. So I would, at this time or point of time, not make any specific statements other than saying that we have a momentum. We are doing better than industry. We did it last year as I told you, even compared to the overall mid-cap domain.
Yeah.
Yes. We would hope to do that this year too.
But what will drive growth? Because I think UK is around 60% of your revenues. US, as you said, things are uncertain. But, at some point of time, post this uncertainty, US as well could pick up, right? So how do you see geography-wise things pan out?
See, we have invested substantially in the tomorrow's technology. That's point one, which is about AI and data. Internally, in terms of improving productivity, and externally, in terms of acquiring a company that we acquired, which focused on data particularly. Now, there is no kind of slowing down in that part of the business anywhere in the world, UK as well as US. In fact, we have booked fairly large order in data-related issues all over this quarter as we speak. So that is one driving engine that we feel good about in terms of growing. That's one. Number two, we have invested substantially last quarter. Some of it got reflected in terms of our profitability, as you so imagine. It is going to give us benefits in terms of growing in the existing market. Please remember, we have close to 100 plus active customers in US, for example. Yeah. And these customers are there with us for last 4 or 5 years, some of them, of course, we have added last year. But each of these 120 customers are an expansion for us, particularly those who are in Fortune 500 and Fortune 1000 area. And given our focus, particularly in healthcare and data and AI that we are training people. We have trained almost 70-80% on AI. We are focused with some projects in AI. I will not take all the names here. I feel confident that we are at the cutting edge in terms of the revenue side of it. And yes, we have to watch uncertainty. That of course we have to be cautious about. We can't just be, ignorant about it. We have to plan, and we are constantly working inside to see how, if at all, we have to refocus or re-strategize and improve our control on the operations in the light of things that are unfolding. And I feel confident, given our new management, we have a CEO, as you know, and our board, we feel confident, Nigel.
All right, sir. Sir, it's good to hear, because that data, AI, that's the buzzword, right? And that's the entire focus out there. And as you said, no slowdown out there. In fact, that's the path ahead. As a percentage of your revenue mix, how much comes in from these segments?
See, presently it is below 10% as a data. And we feel that that is, again, a kind of indicator for us in terms of much more that we can do. And that, as I said, is a growth engine, and we feel confident that we can do that.
Okay, and as both these two verticals scale up as well, I understand that they are margin dilutive, at least in the near term. But still, you're confident that margins will improve this year to the 17 to 19%?
We don't want to make exact statement. That is a direction that we are moving. We want to move back to that number that we had, and last year has not been high in terms of that number, but we have spent that time in investing, and this year also obviously we would like to invest in future, but we would definitely like to improve what we have done over last year. That we are very confident as an overall year, because there has been a focus on improving profitability in house. We have task forces, we have top management working on specific areas. So I'm very confident that we will do better in terms of profitability than last year's number and move towards the number that you are talking.
But Mr. Desai, we can't let you go at that. At least margin band 17 to 19% is an aspiration?
Yes, of course it is an aspiration.
Got it.
Of course
all right. And
we would like to achieve as close to as possible. But as I said, we are moving in that direction, and we would like to do better than what we promised.
All right, 17 to 19%. When you join us at the end of quarter one numbers, maybe we'll push you a little bit more. Lower end of the...
I said not 19%.
not right now, sir. Not right now.
19%. I said we are moving in that direction. and we would like to see whether we can reach that band as soon as possible for the whole year. I don't want to make any prediction on this quarter, right?
Okay.
I'm talking of the whole year.
Okay, all right. And cash of 600 crores in your kitty, it helps at these kind of times.
Sure.
What do you plan on doing with it?
See, as of now, we would like to digest the acquisitions that we have done, Nigel. As you know, we have done 4 big acquisitions over the last 5-6 years. And we are just taking a halt right now and looking at what we can do moving forward. We, of course, have to look at our cash flow and see how we can utilize it the best. But as I always said, we are open, but at the same time, we are not accelerating. We are focusing on our existing operations and how we can move it ahead. If anything comes up, obviously, like any other thing, we are all open. But that's not, we are moving in that direction, that at a high speed.
All right, Mr. Desai, we appreciate you joining in. Thanks a lot for giving us some color. And at the end of quarter one, maybe we'll press you a little bit more for numbers. But as you said, situation's a little bit uncertain out there. You're optimistic on outbeating the industry with regard to growth. Your aspiration is to improve margins, and you're sitting on some cash as well in your books. Thanks a lot, sir, for joining in.
Absolutely, and interesting conversation there. By the way, markets, of course, are absolutely flat, 24,550, just about 8 points on it at this stage. Let's talk about another company, and this is MapmyIndia, or CE Infosystems. There was an analyst meet a few days ago, and the company's set an ambitious target, 30% revenue CAGR over the next 3 years. And of course, I mean, a strong margin guidance, etc. as well. We have Rakesh Verma, co-founder and chairman and managing director at MapmyIndia, who's joining us. Thank you very much, sir. Good morning. Prashant this side. Always good to see you. So you've retained that 1,000 crore top-line guidance by FY28. You did about 460 odd crores in FY25. So 3 years out, 30% CAGR. But if I look at what you've said your order book will be by FY28, that's about, you're saying, actually you said it will be in excess of 2,000 crores. That kind of indicates, a much slower rate of growth in that sense. So is there a bit of a disconnect here? If you can sort of start by answering that, are you going to rely on short cycle projects? Does this include some inorganic acquisitions, etc. as well?
It's not a disconnect, it's the nature of the order that comes every year. So at the end of every year, we analyze, is it the open orders are going to be executed over 4 years, 5 years, 3 years, 2 years? It's different types of orders because, we are in mass, PaaS, and SaaS business. So when we look at this current open order, we believe that it will get consumed in something like a 3-year cycle. So it's that. So when we say 2,000 plus at the end of 5 years, it's not short term, but it is the way, the nature of business that's happening. All the orders are not 5 to 7 years contract. Some of the orders are even 1 year contract.
Right. No, and I completely understand. That's perfectly reasonable explanation, Mr. Verma. Now, let's just talk about where the growth will come from. I mean, you already have a 90% share in automotive navigation. So the growth largely is about how fast the industry will grow. In terms of market share gains, there is only so much now you can do in that sense, in this segment at least. So just talk to us about that.
Well, 90% of the domestic market, right? Now, as you know, we have expanded to Southeast Asia in the automotive sector. The Southeast Asian market is as big as the Indian automotive market, almost same 4+ million vehicles every year. So now that has opened up a new opportunity totally from zero. And we have started earning revenue already. So that, and I'm not saying that we'll achieve 90% in the Southeast Asian market, but we have given a projection already in the analyst meet that from a 26 crore in FY26 to 80 crores or so in FY28 coming from so that's one part of the explanation. From the domestic market itself, the penetration is increasing. The penetration increase irrespective of the industry growth, which you may take it as 3-5%, right? That's what I guess everybody's expecting in the industry. The penetration increase itself is going to increase. Thirdly, the upselling in terms of the autonomy or autonomous vehicles has started with an ADAS 2 already, and we are looking at ADAS 2.5 happening in the next 3 years. All put together gives us a very good picture of automotive sector of our business.
All right. Hi, Mr. Verma. Good morning and good to see you in. This is Nigel on this side. I just want to focus on your segmental breakup. Your auto and mobility segment, that grew by what, around 13-14% in FY25. So in this segment, is this the kind of growth trajectory we should work with, say, for the next 2 to around 3 years? So that's about that segment. And this 30% growth CAGR that you're talking about over the next few years, that will have to be largely led by consumer tech as well as enterprise segment. Is that a fair assumption? A&M grows at, low teens, low to mid-teens, and the other segment grows, C&E grows at a faster clip?
Not really. Certainly that other sector might grow at a faster pace, but let me give the explanation in another way.
Yes.
As per where we informed in the analyst meet also, we have informed the stock exchange also, the company has been reorganized. With automotive and corporate, enterprise has two parts. What you used to call C&E, consumer tech, think of that, corporate. So the automotive and corporate is now going to be part of the parent company itself. So the growth which you were talking about, 13-14%, now the parent company growth has to be looked at, not 13-14, but much more. That's part one. The other business is the government business, which is what we call it as Mapple's Digital Transformation Company and IoT. That has another growth opportunity. Now, the growth, if you look at purely growth, the opportunities in the government and IoT is much, much larger than the automotive and enterprise. But automotive and enterprise brings in a much, much higher margin. So it's a very good combination of the two that we are looking at and going to be operating in two different ways of how to make sure that we achieve the 30% growth overall and we achieve 35% plus EBITDA.
The reason I asked you, sir, was because the A&M as well as the CNDA, they were almost going at a similar run rate. And suddenly the CND now has taken off. It's doing a quarterly run rate of around 90 crores. But we got your point in terms of, the way you see the business pan out. Overall, blended, you're expecting 30% CAGR growth. Got that. Now, let's talk about your fixed pricing contracts. I think they made up more than 60% of your overall new orders, if I got that number correct. In the previous year, it was close to around 30%. So, while the volume-based, well, that's gone down. So, fixed contracts, price contracts has moved up. Can you shed some more light on this sort of a shift?
Again, as I said, every year and we look at what contracts we have gotten. And based on that, we are able to say whether we'll consume the open order in 3 years, 2 years, 5 years, or whatever. Coming to that fixed price, yes, last year we entered into many fixed price contracts. As a matter of fact, it's strategically, in some ways, with certain types of customers, fixed price contract is beneficial to us because we have a very predictable revenue coming from that.
All right. One final question, Mr. Verma, before we let you go. Since defense is the buzzword, can you elaborate on that potential use cases of drones in the defense sector and also your partnership with the DRDO?
Well, to the extent I can share with you, we are primarily into the software aspect of the defense sector.
Yes.
And we are doing lots of projects with them on that front. For us, it's not a buzzword. For us, it's a straight business.
For the market, sir, it's a buzzword, sir. For the market I refer to, it's a buzzword. For you, please explain to us how you see business panning out. Please go ahead.
See, with the kind of technologies we have, which we use in the consumer tech or enterprise or automotive, the nature of business with the government doesn't change as far as we are concerned. It's fundamentally a software-driven, the kind of technology we have developed and we are developing in the drone sector, as you said, is being used by the government, and government means defense, and will be used more and more as the time comes.
Right. Mr. Verma, one last question before we wrap things up. How much of your time is spent on worrying about whether some new around-the-block startup is going to disrupt your business, especially using AI, open source? I mean, I was reading this piece about, I think it's called, there's a company called Open Street Platforms, which is now trying to do this. Using machine learning, AI, etc., to provide real-time updates. I think you also have started something called Clarity X, if I'm not mistaken. So you're trying to do all of that, but is it a risk at all for investors?
No, let's keep Clarity X on the side. First part is what you said, the Open Street, AI, and all that. MapmyIndia has been doing this kind of an AI-based map updation or creation, and moving towards even ADAS 2+ now. It has been part of our, not today, but part of the last many, many years. Now, coming to the competition, how much time I spend or we spend, I tell you, we take it as a noise, not that we don't take noise seriously, but we have seen the noise over the last 20 years. So we are now a lot matured on how to separate out the noise versus something real. We don't see anything real as of today.
Okay, all right. So your eyes and ears are open in that sense. Yes. Point taken. I mean, you were in a world where Google searches have fallen for the first time in 20 years because of platforms like Perplexity. Sometimes nothing happens for 20 years and suddenly things change. Thank you very much, Mr. Verma. Appreciate you joining us. Good speaking with you, and I think provides a fair bit of perspective on the business for investors. We'll take a quick commercial break here. We're going to come back and we'll have Manisha join us on the other side with a focus on commodities. Stay tuned. Coming up. Okay, welcome back. Markets are up about 40 points, so not a bad day. Market breadth is now 1:1. It's evened out. Let's focus on some stocks. Vivek is here with some blocks which have happened and which are likely to happen. Vivek, take it away.
Well, that's right. So we had indicated about 4 blocks that will happen in today's trading session, and within the first hour itself, all of them have happened. A couple of them were pointed out by our colleague Nimesh, and along expected lines. The first one is AB Fashion. Remember, this is the demerged entity, Flipkart, that held a little over 6% stake in the company, completely has exited its stake as per the term sheet that we accessed last evening. So this particular deal, equity over 600 crores actually changed hands. The second stock, it's a very large portion of the equity, almost 1/10 of the percent equity of the company changing hands. So Carlyle today, as per the term sheet that we accessed last evening, has completely exited its stake as far as the software pharma company, that is Indegene, is concerned. Again, over 10% equity changing hands, 1,500 crore worth of equity is what has got absorbed. The other stock was Tata Technologies. Again, over here, remember, TPG, that held 6% stake in the company at the end of the March quarter, remember, had exited close to 4.9% equity in the month of April. And today it was a clean out trade from Tata Tech. Over 2% equity they've sold. So now they don't hold any stake in Tata Technology, post today's block deal. And lastly, Alkem Black, a promoter, continues to trim stake. A promoter by the name of Jayanti Sinha today exited close to 1.4% stake. And again, this was done via the block deal window itself.
All right, Vivek, thank you very much for that. So that's blocks in focus. Let's focus on Spark as well, which opened about 5.5% lower. Ekta with more. Ekta.
Thanks for that. Well, yes, Sun Pharma and Spark are in focus because Sun Pharma and Spark have announced that the top-line results from a phase 2 trial of one of the molecules under development, SCD-044, has not been successful. So, for example, this particular trial was for psoriasis as well as atopic dermatitis. It has not met the primary endpoints in either of the studies, for psoriasis or for dermatitis. Now, the development is being discontinued and there are no further clinical trials which are planned. Sun Pharma and Spark are going to assess what next steps to take. This is a negative because it was considered to be one of the key assets in the company's specialty pipeline, that's Sun's specialty pipeline. But as you can see, there's a drastic difference in terms of the stock reaction between Sun and Spark, because this definitely means more to Spark, considering that they were doing the R&D for this particular molecule. The stock has, the stock has actually corrected quite significantly already from its 52-week high. It's down around 35%, but its 52-week low was at around 100 odd rupees. So people were waiting by for this data to come through with regards to this particular molecule, which was expected now, right about now, and hence it's been a disappointment. And that means that Spark will probably have one of the bigger molecules lost in its pipeline. That's the current update. We'll have to wait and see what the future pipeline of molecules looks like for Spark. As of now, disappointment.
All right. Thank you very much, Ekta, for that. It's a very sharp cut coming through. Well, let's shift focus to the commodity space now. Manisha is here with what's top of mind. Manisha, good morning.
Morning, Prashant. I'm looking at the silver prices because while there's quite a bit of a volatility across board, but silver seems to be holding around that 34.5 kind of levels, which is near 7-month highs that we've seen for prices. And silver, for the very near term, seems to be outperforming gold as well. It's gained 5% in the matter of last 1 week. It's up 7% in a month. It's up 21.5% in the last year. And this year so far has gained up by nearly 20% as well. Well, there's a lot of support coming in for silver. One, of course, it is because of the safe haven buying. We are looking at various geopolitical tensions, slowdown concerns as well. The weak economic data that we seem to be looking at from Europe, from China and US as well, especially China, where we are looking at weaker numbers, is what really has led to silver buying there. The markets also are anticipating that we could be looking at the US Fed interest rate cuts in the month of September. There's almost a 75% probability of that is what the street is working with. And then the silver usage in EVs, electronics, AI and data centers, healthcare application really seems to be expanding. Well, just to give you a sense of number, the modern solar panels use 120% more silver per kilowatt versus the older models. And that is what really seems to be working right now. And that is what the markets are doing in sense of a calculation. The photovoltaic sector also accounts to nearly 15% right now of the global silver consumption. Well, we've seen those numbers continue to increase as well. And then industrial applications and fabrications at this point account for 55% of total silver demand, and 45% is used in sense of investment, jewelry, artifacts, etc. Much of that clearly coming in from Asia. Some more numbers on your screens, and that should tell you on the industrial demand. Last year was a fourth straight year of record industrial demand for silver at 680 million ounces. And this year it's anticipated even higher, a fifth record year, by the way, at 700 million ounces. And also when you look at the global silver estimates, we're looking at a production of 850 million ounces, while a demand is anticipated at 1 billion ounces. 2025 is also going to be a fifth straight year of global deficit when it comes to silver, and markets do anticipate that silver will continue to outperform gold in the coming couple of years as well.
All right. Well, thanks very much, Manisha. So precious metals, gold, sometimes silver now, as Manisha points out. Well, we'll take a quick commercial break here. Our special segment, it's the economy on the other side. Lata will be speaking with Chetan Iyer, Morgan Stanley on tariffs, the RBI policy and more. Stay tuned.
Welcome to It's the Economy. Morgan Stanley sees a serious growth slowdown due to the tariffs. It expects US growth to slow from 2.5% in 2024 to 1% in 2025. Global growth is expected to slow from 3.3% last year to 2.9% in 2025. Asia's from 4.6 to 4.3 as the table is indicating. And India's growth is expected to slow from 6.7%. This is calendar, okay? Calendar 2024 to 6.2% in calendar 2025. Now, what does this mean to inflation, interest rates, yields, dollar, rupee? I have with me Chetan Ahya, the chief Asia economist for Morgan Stanley, joining us from the sidelines of their conference. Good morning, Chetan. Thank you very much indeed for your time. Well, let me start with my India bias. The latest GDP numbers were stronger than expected. It beat our poll even in a full year basis. So our poll said 6.3. The numbers come at 6.5. Does that enthuse you a bit that India may do better than the 6.2 you have forecast for the current year?
Yeah, I think it's possible. But look, I know the GDP numbers were a bit stronger. But if you look at it adjusted for the indirect tax effect, then the number was 6.8. So right. I think the underlying number was less robust than the headline number. But nevertheless, I think it's definitely indicating that India is at least having a starting point before the tariff effect takes in. Which is, it's much stronger than, in fact, everybody in the rest of the world as well. Okay. So it's possible that our FY, I mean, yours is a calendar forecast. Will the FY forecast have an upward bias? Is there a chance it will be upped? Well, I think at this point of time, we are saying that the risks are balanced, because, from a global perspective, you have this tariff uncertainty. And, our global team thinks that there are downside risks to that global view, which lends some downside risk to India numbers as well. But at the same time, the India-specific factors, i.e. that policy support has been great. As you saw, March number for both central and state government for capex were extremely strong. So the starting point for India is from the policy support such that you could have that downside risk being balanced by the domestic factors. Oh. So at this point of time, Lata, we are still maintaining our base case growth numbers for India. Okay. Let me come to disinflation. You make a strong case that disinflation is likely to continue in Asia. Will that apply to India as well? Very strong disinflation? Yeah, exactly. I think all the points that we're thinking about for the region is applicable to India. The starting point of inflation is low, i.e. that it's actually below target. You have lower oil prices. You have this tariff effect, which is deflationary for emerging markets and Asia and India. And at the same time, you have the strength in the local currencies in the region, including INR. All of these factors mean that inflation is likely to remain below 4%, and that actually provides great comfort to the RBI to go ahead and take up rate cuts. Okay, and that's what I was coming to. If I mean, your inflation forecast will run alongside as you speak. You have a 3.8% inflation for the full year. And yet you say that the RBI will give only 2 more cuts. Why can't they go more aggressive if your expectation is that by Q4 we go as low as 3.6? Isn't there space for more cuts? Well, I think the framework that we are approaching this is that, you will have real interest rates in the ballpark of about 1.5%. Okay. And considering that, we are not expecting a big dent to India's growth story, since growth conditions will still be reasonable, we think RBI should take up 2 more rate cuts. Now, if we are seeing further downside to our growth numbers, then we are saying there's a possibility the RBI does 75 basis points instead of 50 basis points more. But I think anything more than that would really be dictated by the growth outcomes. They have to be much worse than what we are building in right now. Okay, much worse than the 6.2% that you all are factoring in right now. That's right. Okay. Well, let me come to the dollar.
we have been surprised by the kind of weakness that we have seen. Will this pass? Do we see it go back above 100, the DXY that is? Or is dollar likely to remain, a weaker currency?
Well, our house view is that the dollar will remain weak. We are expecting another 9% odd depreciation in the DXY. We think euro and yen are going to be appreciating strongly against the dollar, but also emerging markets will see some upside. Not as strong as euro and yen, but they will also see some upside. So yeah, that's the dollar view. The driver for that thinking is essentially twofold. That tariff-related uncertainty plus the additional policy actions that the U.S. has taken will slow U.S.'s growth more. Just if you take the example of growth differentials between U.S. and Asia, U.S. will slow from 2.5% in fourth quarter last year on a year-on-year basis to 1.1% by fourth quarter of this year, whereas Asia in all will slow by 90 basis points. So U.S. will slow by 150 basis points, Asia will slow by 90 basis points, and India will slow even less by like 50 basis points. So we are going to have that dynamic where growth differentials are moving back in favor of Asia and also rest of the world. And then the other driver is that the U.S. is running relatively high fiscal deficit, which is in turn drawing current account deficit of 4% of GDP. These are the main fundamental factors. And on top of it, there are some concerns related to the provision that they have made in the bill that has been passed in the House. It's called Section 899. That is raising some concern in investors' mind about potential taxing of income from investments in the U.S. So I think a whole lot of factors are at play, but net-net we are expecting this weaker dollar trend to continue.
Yeah, actually, the Section 899 has not been discussed enough, probably because it impacts OECD countries more. But be that as it may, what is your US team telling you about US yields and the Fed action? Can we continue to have such a interest rate differential narrowing between India and the US?
So we are expecting the U.S. 10-year bond yield to go down to 4% by end of this year. And the assumption that we are making is that as U.S. growth slows and job growth slows, market will begin to price those rate cuts that we have, a lot more of those in 2026. But market gets ahead of that and starts to price in from the back half of this year. And that's how we are seeing 10-year bond yield going down to 4%. So, yes, there are concerns on fiscal deficit, but to the extent to which the private demand will slow, that will result into job numbers slowing and then expectations that the Fed will cut rates.
Okay. What's your sense about Indian 10-year itself? Do you see it going below 6%?
I don't make that forecast, but
okay.
we are not making as a house the 10-year bond yield forecast.
Okay, no, I get your point. It's not your area, it's the bond guy's area. But considering that the Reserve Bank has been extremely generous with liquidity, even today, even as we speak, the repo rate is 6, but the call rate is 5.75. So actual rates, one-day rates are far lower than what the repo rate is. So I'm wondering if the 10-year will go even lower. Chetan, there is one factor that is not getting discussed enough in terms of growth, and that is the way in which China is sitting over the rare earth magnets. It was a month ago that Rajiv Bajaj told us that I fear we don't have enough rare earth magnets and the Chinese are stopping them. Yesterday, we had Sudarshan Venu of TVS telling us, and today we understand SIAM, the Society of Indian Automobile Makers, has written to the government saying that production can come to a standstill. Will this be an unexpected quarter, area which can impact our growth, the Chinese behavior?
Well, I think that risk is there, but from what I understand is that there is a process that China government has put out, And unfortunately, if the process is such that every country and every country's private institutions have to give some kind of an undertaking to indicate that this is not going to be used for defense, that process is a very time-consuming process. If you want to deal with the whole world in an individual manner, so I think that time limit that is involved in processing those documents and requests is what is, I think, causing that delay.
Okay. What the SIAM tells us is that the Chinese Commerce Ministry, as you say, is not giving permission to those 9 importers of rare earth magnets. It's just that this is slowly inching up. It was a stray comment by one industrialist. Now it is up center with the entire auto sector worrying about rare earth magnets. Aside from all this, Chetan, let me come back to India and Asia. How do you expect currencies to behave? You said that your team is expecting dollar depreciation to be a theme, continued theme. Do you expect rupee strength? How will the dollar rupee behave?
Yeah, we are expecting strength in rupee as well. In fact, we are expecting a modest 2 to 3% appreciation across the region. But, one of the main anchors for region will be RMB, right? And for RMB, to the extent to which they have deflation problem in China, we think that there will be less appetite on the part of the Chinese policymakers to resort to some meaningful appreciation, like what you're seeing in euro and yen. And at the same time, tariffs are unfortunately going to hit China the most. So both those factors, we think, will mean that RMB will sort of constrain the overall, region's currency appreciation. It won't be as strong as what you're seeing in euro and yen.
Okay. So you're likely to see a very rangy movement. Just a final point. Is this pain about to last for a year more? Because then the US midterm elections come in, and then low growth and high inflation could become election issues. So do you think there's greater relief in FY26 for India and for Asia?
Yeah, I think we should see an improvement in growth trajectory for back half of this financial year itself. Because, we are seeing that tariff effects will be most acutely affected until fourth quarter of this year. And then from first half of calendar year next year, you should see improvement in growth across the world, but particularly out in India as well.
Okay. We'll have to leave it at that. Out of time, Chetan, and I assume that you have to go back to your investors. Thank you very much for sparing time for us. Enjoyed the chat. We have to wrap up on Bazaar on that note. Chartbusters coming up.